Hi everyone, welcome back to the 1% Common Sense channel where I uncover simple yet effective common sense habits and practices applied by the richest 1% of the world to create generational wealth. In our last video, we discussed various programs available to first-time home buyers and how they can make most out of it. Please click here if you're a first-time home buyer to watch that video. Today, we are talking about investment, and broadly there are two ways to save and invest: registered and non-registered savings plan. Under registered plan, you have some of the other tax incentive to save and invest, and they include RRSP, TFSA, and FHSA account. Under non-registered, neither the contribution nor the income is exempt from the tax. In today's video, we're going to talk about RRSP, and there is so much to talk about RRSP, hence we're going to divide this video in two parts. In part 1 today, I'm going to give you a basics and important guide to get started with RRSP, and will also provide some interesting insights and strategies for you to consider to make the most of this investment account. So let's get started. So what is an RRSP? An RRSP is an investment account that lets you save for the retirement on a tax deferred basis so that your investment can grow faster. According to me, it's a way that forces you to inculcate a habit of investment rather than spending by penalizing you paying higher taxes if not contributed. Remember this, the richest 1% of the world hate paying taxes and they do everything, including moving countries, to avoid paying taxes. Your way to the 1% club is dependent on how less you pay in taxes. So what is tax deferred? Basically, it lets your investment grow tax-free until the time you withdraw from the account. So you might be wondering, what's the point? By paying taxes in the future, where is the savings? But that's still meaningful, as remember, money saved today is worth way more than money saved tomorrow. And think of it that way, that you have eventually borrowed from CRA interest-free, and you will earn compounding return on that money you will invest and pay taxes later. Also note that RRSP is just a channel and not a final product, and from there on you can choose to invest wherever your goals or preferences dictate, such as US equities, Canadian equities, gold, silver, Bitcoin, real estate, GICs, etc. So what is the eligibility to invest in RRSP? Number 1, you should be a Canadian resident for tax purposes. Number 2, you should have filed your income tax return in Canada. And number 3, there is no minimum age requirement to contribute, but you should be maximum of the age of 71 to contribute. What is the maximum RRSP contribution limit? The maximum RRSP contribution limit is the 18% of your last year's tax filed non-investment income and subject to maximum of $31,560 in 2024. This maximum cap increases by some amount every year. Eligible income includes your business income, salary income, rental income, but does not include your investment income such as dividends, interest, capital gains earned on an investment. Any contribution room earned but not invested gets accumulated and can be claimed in deduction in the subsequent years when you make investment. I know this all calculation of current year, past years, limit room can get overwhelming, but don't worry. When you log into your MyCRA account, all this information is available to you on your fingertip. Also note, many employers offer registered pension plan on top of your RRSP to inculcate a habit to save for retirement. Please note that any amount contributed to such plans also gets counted towards a contribution in RRSP. For example, if you and your employer contributes $5,000 each to this RSP, total $10,000 in this case will be deducted from your RRSP contribution limit. However, please note that this $5,000 from your employer is basically a free money to you, and you should take the most advantage of it. Here is an important strategy for you to consider. Please note, while you contribute to your RRSP in any given year subject to your contribution limit, you can choose to defer income tax deduction claim in the subsequent years. And ideally, you should claim your income tax deduction when your income increases and makes you move from one marginal tax bracket to higher marginal tax bracket. Here is an example for you to consider. We are only considering federal tax rate in this case to make things simpler. Suppose you are earning a salary below 55,861 in the current year and you made RRSP contribution. Your marginal tax rate in this case will be about 15%. Now assume that you expect your salary to increase beyond 55,867 and hence you will be under the marginal tax bracket of 20.5%. In this case, it will be prudent for you to claim your deduction in the subsequent year, and whereby you can get income tax deduction of 20.5% versus 15% if you claim your deduction in the same year. And similarly, if you're currently in 20% marginal tax bracket and you expect your income to increase and put you in the 26% marginal tax bracket, you should ideally postpone your income tax deduction to the next year so that you can get the maximum benefit out of income tax deduction. Now that you are convinced to open an RRSP account, your next question might be, where can you open an RRSP account? You can open an RRSP account in any bank, financial institutions or a brokerage firms which offers you such products. And unless you are registered by your employer, you should choose to open an account where overall fees are usually less, especially the transaction fees, and they offer you wide range of investable products. The deadline to invest in RRSP is in the current year and up till 60 days in the following year. So for example, your 2024 RRSP contribution limit of $20,000, which is based on your 2023's tax filed income, you can invest in the whole of 2024 and until 1st March 2025. When you can and should withdraw from your RRSP. As per CRA, you can withdraw from your RRSP anytime before the age of 71 by paying taxes. At the age of 71, compulsory withdrawal kicks in. But ideally, you want to consider withdrawing from your RRSP for following reasons. Number 1, when your income is lower and you are in low tax bracket. Number 2, you're withdrawing to buy your first home under first-time home buyers plan. Number 3, you're withdrawing for further studies under lifelong learner plan. And number 4, any unforeseen withdrawals. Here is an illustration of how premature withdrawal can cost you. Suppose your current income is $100,000 and you invested $18,000 in RRSP and claim income tax deduction, and hence your taxable income dropped to $82,000. In this case, your marginal tax bracket is about 20% under federal tax rate rules. Now suppose in the next year, you had to withdraw from your RRSP for any unforeseen event and your current income still stood at $100,000. This $18,000 will be added back to your income, and in this case, your taxable income will be $118,000, which makes you to be under income tax bracket of about 26%. And hence, when you claim deduction, you claim 20% income tax deduction, whereas now you have to pay 26% on this $18,000 that you withdraw from RRSP. So what is the key takeaway from this? You should only invest in RRSP once you created an emergency fund of about 3 to 4 months of your monthly expenses so that you can avoid such premature withdrawals. With that, I'm concluding the RRSP Part 1 video. We will come back on RRSP Part 2 with more benefits and strategies for you to consider. I hope to see you all next week. Until then, take care.